right, welcome to the video. Let's just jump right in because today we're taking a hard look at a system that literally all of us use, we all trust, but honestly, we rarely ever question. We're going to unpack some incredible source material that completely pulls back the curtain on how the banking system actually operates behind the scenes. And I got to tell you, by the end of this, I'm pretty sure we're both going to be looking at our money and our savings accounts in a totally different way. So let's get into it.
Okay, just let this number sink in for a second. $36 billion. That's not revenue, guys. That is pure profit the banks made in a single quarter. One quarter. Think about that. That is the cash left over after they've paid for all those massive downtown skyscrapers, every single branch employee, all the servers, the whole shebang. And the craziest part? Almost none of that massive pile of cash came from that annoying $12 monthly maintenance fee on your checking account.
So that brings us to the big mystery we're looking at today. If these massive banks aren't building their empires on checking account fees, where on earth is all this money coming from? Like, how exactly is this giant banking machine extracting so much wealth from everyday people just trying to go about their lives? Well, the answer actually involves your savings account, your mortgage, your credit card, and a financial system that operates almost entirely in the background.
Now, what's really fascinating here is how simple the core engine of a bank actually is. At the end of the day, a bank is really just a middleman. You give them your money, your deposits, right? And they pay you a super low interest rate for the privilege. Then they immediately turn around and lend that exact same money to somebody else at a much, much higher rate. That gap between those two numbers, that's called the net interest margin. And that margin is basically the beating heart of their entire business model. Every dollar they make starts right there.
Let's put some real numbers to this so you can see what I mean. Imagine you deposit 10 grand into a standard savings account at one of the big major banks. Right now, they're going to pay you, maybe 0.5% in interest? So you make about $50 a year. Wow, right? Meanwhile, the bank takes your 10 grand, lends it out to someone buying a house, and charges them 7%. That makes the bank $700 a year. They quietly pocket that massive $650 difference. Now just multiply that by tens of millions of customers. But wait, it gets crazier, because the machine is way more powerful than just a one-to-one loan. There's this thing called fractional reserve banking. Basically, banks aren't just lending out the exact amount you deposit. By law, they're allowed to lend out a huge portion of it. And when that borrowed money gets spent, it ends up deposited in another bank, which then lends most of that out again. It's this massive multiplier effect. Your single $1,000 deposit can actually support $8,000 to $10,000 in loans across the whole system. You're not just storing your money with them, you're giving them incredible leverage. Section 2, the 5 wealth traps. Now that we know how the basic engine works, let's dig into the specific, kind of hidden ways banks actually trap your wealth and compound those massive profits. Trap number 1 is the savings trap. So think about inflation, which is currently running around 3%. Now compare that to your average big bank savings rate, which is stuck way down at roughly 0.5%. Do the math there. Every single year you leave your money sitting in a standard big bank account, it's literally shrinking. You're losing about 2.5% of your actual purchasing power, while the bank takes that exact same money and earns 7% or more on it. That gap is not an accident, guys. That is their primary product. And you know what's really frustrating? You actually have options. High-yield savings accounts at online banks are offering 4.5% to 5% right now. They have the exact same FDIC insurance. You have the exact same access to your cash. The only difference? Those online banks don't have $20 billion in brick-and-mortar branches to pay for, so they actually pass that profit margin back to you. Okay, trap number 2. This one should honestly make you a little mad. Credit cards. The average credit card interest rate in the US right now is 28%. 28! That is literally the highest rate in recorded history. Whenever the Federal Reserve bumps up interest rates, banks instantly pass those hikes right onto you. But when the rates settle back down, somehow credit card rates mysteriously stay sky high. Let me show you the brutal reality of carrying a balance. Say you borrow $5,000 and you only make the minimum monthly payments. You're going to pay over $14,000 just in interest. So to borrow $5,000, you're paying back $19,000. And remember, the bank's actual cost to get that money to lend you is maybe 5%, but they're charging you 28. That is a massive 23-point margin on something that costs them next to nothing. Then we hit trap number 3, the overdraft trap. U.S. banks collected around $8 billion in overdraft fees in just one single year, and mostly from people who were already struggling to make ends meet. But here is the really dark part. Banks have actually been caught deliberately processing your daily transactions out of order from largest to smallest. Why? Because draining your account faster with one big purchase triggers a cascade of $35 overdraft fees on all your smaller purchases that same day. It's entirely by design.
Trap number 4 is cross-selling. To a bank, you aren't just a checking account. You are a sales funnel. Every single product, mortgages, auto loans, credit cards, carries a huge profit margin. So they use your financial data to target you exactly when they know you're most profitable. And this pressure to sell gets intense. I mean, remember the massive Wells Fargo scandal? Employees were so crushed by these aggressive cross-selling quotas that they opened over 3.5 million fake accounts without customers even knowing. 3.5 million.
And finally, trap number 5. This is the one you literally never see: interchange fees. Every single time you swipe your debit or credit card, the merchant you're buying from pays a hidden fee, usually between 1.5 and 3%, directly to your bank. The store absorbs the cost, but the bank gets a cut of literally every purchase you make every single day. In the US alone, banks rake in a mind-blowing $90 billion a year just from this invisible swipe tax. So when you step back and look at all 5 of these extraction methods together, you really start to see the compounding effect. If you've got money in a low-interest savings account and you carry a credit card balance, and maybe you get hit with an occasional overdraft, plus you use your card for everyday purchases, you are feeding the machine from every possible angle. A single household can quietly transfer thousands of dollars a year to their bank, and you never even write them a check for it. All right, part 3, the counterplay strategy. Because look, the good news here is that you don't have to just sit there and be their product. There's actually a very straightforward playbook to route completely around this machine and protect your money. It really boils down to 2 incredibly simple, high-leverage moves. If you do these, you pretty much eliminate the damage from all those traps we just talked about. Move number 1, switch your money to a high-yield savings account, like today. Move number 2, never, ever carry a balance on your credit card. Let's break down the actual math to see why these 2 steps are absolute game changers. Let's look at move 1. Let's say you have a $20,000 emergency fund sitting in one of the big traditional banks. Right now, it's making you maybe $90 a year. But if you take 15 minutes today to move that exact same money over to a high-yield account, again with the exact same federal protection, it suddenly yields $960 a year. That is $870 of absolute literal free money that you were otherwise just leaving on the table for the bank to keep. And move 2 completely neutralizes the bank's biggest weapon. If you just pay your credit card statement balance in full every single month, you pay 0 interest. None. The math completely flips in your favor. Think about it. You are now using the bank's money totally for free for 30 days, you're stacking up reward points and cash back, and the bank gets absolutely nothing from you except that hidden merchant fee. So zooming out for a second, the reality here is that the banking system isn't broken. It's actually working perfectly, but its design heavily rewards financial knowledge. The people who understand how the machine works just route around all the expensive parts, and the people who don't understand it, they end up subsidizing the ones who do. It's not some grand conspiracy. It's just information asymmetry. If you don't know the rules, you're the one paying the price. Which brings us to the final question to wrap up this video. Are you the consumer or are you the product? Because now that you can actually see the machine for what it is, you have a choice. Take 15 minutes today. Switch your accounts, stop carrying that balance, and stop feeding their profit margins. Empower yourself with this knowledge and take control of your own money. The ball is in your court.